Okay, so we resume our session. Uh, just to recap that we are doing the consolidated balance sheet. Um, you will also study the consolidated financial statements of your case company. It could be possible that your company doesn't have any affiliations, etc., abroad, so then you are a standalone company. Standalone means one company, no other things, just one by yourself. But make sure that you have the consolidated. It could be written word, it could be assumed. We have done the asset side. Now we go to the liability side. And here you can see that, I'll come to equity afterwards. You can see here that you have the non-like assets, you have the non-current and current words as the prefix in the title. And you can see here that all these liabilities are the non-current. First of all, before you go into current and non-current discussion, you must come to the basics. Always go back to the basics. The basics say that liability is what you owe to the others. So these are your owings, not ownings, but owings. Okay, what you owe for the non-current period, which means you have to repay after 364 days. The first thing is deferred tax liabilities. The company every company owes a lot of money to the state exchequer. And one of the form of this owing is called tax liabilities. This is a tax which has arisen, but the company, the FinAir, has not paid it yet. Like individual, you as an individual or I as an individual would receive the from Vero, I would be getting some kind of statement that, hey, this is your annual income, this is blah, blah, blah. You need to pay tax by this amount. So you have to pay, first file the tax return, you send it. If everything goes well, then it shows that your tax liability is this much on this date. They give you deadline, yeah? So this is a tax which the company is going to pay, not in the next 364 days, but afterwards. Okay, so it's a long-term liability. It's a deferred tax liabilities. The money which the company owes to the state treasury, state taxation, but the repayment will be after a year. So you could see that 73.9 million is the money which the company has not paid yet to the state. And then comes interest-bearing liabilities. Interest-bearing liabilities. The interest-bearing, first of all, let me ask you one thing. When do you pay interest? On what items you pay interest? I will not say receiving, because why I would say paying, because we are talking about the liability side now. When do you pay interest? On the loans, exactly. So this is that loan, the loan you have taken. It's not a grant, it's not a charity, it's not a concession. This is the loan which you would pay interest on. So what word? Interest. Again, you have companies. Case you would see the word debt or finance debt or financial liabilities. Very rarely you would use this expression called interest-bearing liabilities or something like that. So be careful. You may not see the same words in your company, but the meaning is same. That's what I'm saying, that be very comfortable with each and every word used in income statement and liabilities and the balance sheet. So be very sure. Okay. Usually you never see this long expression called interest-bearing liabilities. You see it as just debt or a loan loan, debt, finance debt, financial liability. These are the common expressions. But basically it means same thing. Then comes pension obligations. Pension obligation. I hope you know that when you work as an employee of a big company like Finnair, right? Every month you get a salary, but in the salary, you will also see in your salary statement that how much money your employer, not you, some money from your salary is cut as a contribution to the pension fund. But at the same time, your employer is also making some contribution to your salary as a pension contribution. This money is a part of your gross salary, not the net salary. Gross, because this money, even though is given to you, but not given to you in cash, but given to the pension fund straight away. So basically, this is the contribution by Finnair to its employer's pension fund, that when those employees would retire, when they cross certain age, or when they take voluntary retirement, then they would get some money as a pension. Okay, but the company would make this contribution. So hence it's a company's liability to pay pension fund to the pension fund on behalf of its employees. So this is a company's liability. Do you get my point? Company is legally bound to make this contribution. All right. The most horrible thing company can do is that it doesn't make any contribution to the pension fund, and it just eats away this money in some gambling or something. So, but of course, a big company cannot do like this. But there are some bad examples where when the companies were totally off the hook, they used this pension fund, which was meant for employees' welfare. Believe me, when Enron became bankrupt, they were actually, it was only in the books that they were making a contribution. In fact, all the pension fund, which belongs to the employees of Enron, they were speculating it. They were investing in very risky projects at that time. Okay, so this could be possible, but I don't think it's ever thinkable in case of Finnair, because in Finnair, state is a very big investor. A large chunk of shares belong to the state in Finnair. Okay, so that's why the states are normally well behaved. And then one more word you might see in the liabilities is called provisions. Provisions. Okay. Now, provisions are very important and very interesting thing. Maybe I give you an example. Please remember, we need to go to flashback now. The flashback is that we have to recall our memory. Remember, you always make the income statement first before you make some structure of your balance sheet. Your final item in your income statement is net profit, or some people call it profit after tax, or the earnings after tax. I think we discussed it last week. Net profit. Now imagine the net profit is 100 euros. A company would make very insane decision if it gives all this 100 euros to its shareholders. The wise decision would be to save some money. To save some money, let's say 40, give to, as a dividend, we use the word, give to the shareholders. 60, you make provisions. Why do you need provisions? Provision is that if you have an emergency to meet, the 60 can help you. If you want to buy something, if you have to make some quick short notice investment, you can use it. And even if you have some kind of emergency, financial emergency, you can use like the households. We earn. Do we spend all the money? No, we always keep some money somewhere that, you know what, if there is any emergency, we can meet it. We don't know. We can't forecast it, but we always keep prepared to meet this, what's the word? Unforeseen, unforeseeable contingencies, unforeseeable situations, which usually are unpleasant situations. They can put you pressure. They can stress you. So what you do, you create these provisions. Mari raised a point some time ago. She said that, what if the people who are your receivable don't pay you? I, as a wise finance officer of a company, I would keep this thing into my head that last 10 years, 3% people don't pay me. You get my point? There are 3% receivables who don't pay me. Then I would extract some amount from my final profits and keep as a provision that maybe the 3% rule will apply next year also. The question is, do I have to be proactive or reactive? If I'm a reactive, then I would only wake up when I come to know that these 3% people will not pay. They run away, don't know. But if I'm proactive, I would be mentally prepared. Mentally and by resources, I would be prepared to meet this challenge. Of course, I would be very angry to know that people who owe me don't pay, 3% of them. But at the same time, all is not lost. I made my financial planning in a way that I have 3% of such saving somewhere. These are called provisions. These provisions can be for good reasons. The good reason is that you want to expand your business. You have certainly a good project, okay, invest it. Or the bad reasons is that maybe somebody can default with you, so you'll be suffering, so you prepare yourself. These are called provisions, and because it's a company, the company is not using it. It's a money which belongs to shareholder, but the company is using it. You know, so it's a company's liability. Again, the other liabilities could be, they're all miscellaneous, all put together, because those items are too small to be shown separately, so you club them. I think you can also use the word miscellaneous for it, or sundry, or others, or whatever, but basically it means all same. And then comes your short-term liabilities, the current liabilities. And you can see that provisions come again. Like these provisions are maintained for over 1 year, but these provisions could be meant for less than a year. Okay, so you make some short-term provisions and long-term provisions. For instance, if I know that I need to buy a big machine, very valuable machine after 2 years, okay, then I start creating a provision which would be non-current provision. Yeah. So we keep on. Again, you have the interest-bearing liabilities, which were for the long period. You also have the interest-bearing liabilities for the short period. I repeat, when you look at your company accounts, you might not see the same words. Interest-bearing liabilities is a very old-fashioned expression, and generally we call it debt or loan or finance debt or finance liabilities. But you never know. And once again, the trade payables. Remember the receivables? Remember that when you were studying assets, there was a word I can show you right now. There was a word receivable, yeah? Trade receivable, it was in the current period. It was also in the long period. So the opposite of receivable should be payables. Receivable are those people who must pay you, but not now, later. Normally they are your customers, right? Payables are your suppliers to whom you bought something from or had the services of, but you haven't paid them yet. If you pay them after a year, then they should be in the non-current liabilities, right? But if you pay them within a year, then they would be appearing in the current liabilities. And you can see that there's no payable in the non-current, right? It means what? Finnair is paying to its all suppliers within a year. There's no supplier of Finnair who has to wait for a year or more, yeah? So they don't have any payable. Trade payable mean the normal trade activities, and if you have to pay, normally the trade activities you do either with the supplier, when you have the reverse engineering, or with the customers. So there's a backward linkage of a company with the supplier and the forward linkage with the customer. If customer owe you receivable and then you owe to supplier payable, question is receivable or payable for the short period or long period. Short period, current. Long period, non-current. Simple. And then once again, I will not explain it, even though I explained to some people. This is when we do the second assignment, but this can also be a liability. And then comes deferred income and advance received. What does it mean? Deferred income and advances received. Why is it a liability?
There is advances received that you have received prepayment from the customer, but you haven't delivered yet.
Yeah. Yes.
The beginning part of it, advances. Well, income. Well,
yeah. Yeah. When you okay, all right. Many of you, I know, you have these rented apartments in Coas. Just imagine, even if you don't. If the rent is due this month and you have not paid, yeah, then it's a liability yours. But it's an asset for Coas, because then you are Coas receivable. Receivable means you gave service to somebody, but the customer has not paid yet. Receivable means the Coas is yet to recover the money from you. But why it's a liability for you? Because you have to pay it. You haven't paid it. Do you get my point? But what if you are traveling next month and you make an arrangement with Coas that, you know what, I pay you this month's rent, but I also pay you month advance for February. This advance payment which you make is your asset. You have an edge over Coas. Hey, I paid you more than I'm required to pay. And this is a liability of Coas because they got extra money from you. Now they owe you an extra service. See, it's a little bit psychological thing. So same way, the companies sometimes get deferred income. They gave some service, but they get money in advance. Or they have got some prepaid. They have not given service at all yet, but the customer has paid in advance. So then it could be, then it becomes customer's liability. Then it becomes your liability towards your customer. Okay, do you get my point? So when you have these kind of extra income, money belongs to only 2018 would come here, because this is the 2018-17 data, right? But if the customer has paid you for a year advance, then it becomes your liability. Okay? Is anything else? Liabilities related to the employee benefit, maybe some benefits, not pension, but something else. Because company doesn't give only pension as a benefit. There could be some other benefits. And FinAir has not given yet to its employee. So the 139.2, no, it's 139.2 million benefits which FinAir owes to its employees have not paid yet. But remember, they are not going to go beyond a year. So they would be settled in less than a year. Okay, and if you put it together, it all together comes to be, It all together. This is some kind of exceptional item. It says liabilities related to the asset held for sale. So this is some asset which asset held for sale. I have sold an asset in books. Mari, I sold you some machinery. The deal is done, but the machine is not delivered to you yet. It means I'm using that machine. So technically it's liability. Machine belongs to you, but I'm using it. Okay? So these kind of minor exceptional items can also show up. It's a very exceptional situation when you have this kind of. So maybe FinAir have agreed with a small aircraft that they would lease out their plane to them, but FinAir is still using that plane. So these are, once again, FinAir is not the only example. I'm just taking a case study of FinAir to discuss about assets and liabilities. Okay, and if you see all together, the current liabilities, the non-current liabilities are this much, whereas the assets are this much, and the gap is called, as we discussed before, equity capital. This is the money, which is the difference between total assets and total liabilities of FinAir. It means this is the money which belongs to the FinAir's shareholders.
I have a question. I think all provisions for tax.
And the difference between total assets and total liabilities is called total equity. And you can see that for FinAir, the share capital is 75.4 million, and the other equity. The other equity is a very interesting word. Basically, it's a non-share equity. Don't forget that state is a very big investor in the FinAir. And they don't have share. They will not have in the trading shares. The shares are the one which are trading in the stock market. Okay? And you can have the non-share capital, which is normally, I would say, in the state-dominated companies. They have the share, they have the capital, which is not very trading. They don't trade it. I mean, the state is not trading FinAir's shares in the stock market. They're more like fixed. Okay? So the difference, anyways, the equity capital is a difference between total assets are this much. Total liabilities are, where are they? They are here. And the difference between this and this is equity capital. And you can see that the equity plus liabilities are same. So we know that the total of assets and total of liabilities plus capital will be same. And believe, and if I remind you, to me, capital is also a kind of liability. Liability to self, to the shareholders. And to me, liability is more like an external liability to outsiders of the company. But I think when you are a shareholder of a company, you become part of the company. So that is why the equity is basically liability that the company has to its own shareholders. Now, what do you do now for the rest of the time? Whatever time we have, I think we have good time.